Now earlier we talked about paying for things with a check. And that's true. It's always best, as much as possible, to pay for all of our expenses with a check because it creates automatic documentation. But in order to pay our expenses with a check, we have a system that we use, and it's called the voucher system. And this is a very important part of our internal control system. Now, the reason that we have to have this is because in a business, you're constantly receiving bills. You're constantly receiving statements. And you don't necessarily know if they should be paid for or not. How do you know that it is a legitimate bill? Maybe you received it by accident. Or maybe they've sent it to you intentionally just to see if you'll go ahead and pay for it. How do you know that the merchandise was even ordered? How do you know that it has even arrived? So you really have to be careful, and you can't just start paying a bill simply because you received it. So that's really the purpose behind the voucher system. Now the way this works is we're going to have different documents, and each document has a very important role in the system. So the first document is called a purchase requisition. And basically, every time an employee wants to purchase something or order something, they must fill out a purchase requisition. And on that requisition, they're going to describe what it is that they're ordering and where they're going to order it from and what the prices are. And then someone's going to review that. And if it's appropriate, then their supervisor will sign that purchase requisition. But if it's not really an appropriate purchase, they will refuse to sign it, and then it stops right there at that level. But assuming that this is a legitimate purchase and that the supervisor agrees that it's a legitimate purchase, then they will sign the purchase requisition and we move on to step 2. At that point, we issue a purchase order, and our purchasing department will actually buy the product. And when they do that, they fill out that purchase order. Then after a certain amount of time, we will receive the next document, which is the invoice. The invoice is the bill. This is the bill that we receive from the vendor from whom we purchased this item. Then we have a receiving report. Now this is filled out when the merchandise arrives. And when the merchandise arrives, we're going to look at the merchandise, make sure that it's the correct merchandise, make sure that it is not defective, and if everything is in good order, we will fill out this receiving report. Then we have the invoice approval. Now the invoice approval is like a checklist. And on that invoice approval, we're going to ask ourselves, do we have a signed purchase requisition? Do we have a signed purchase order? Do we have a invoice? And do we have a signed receiving report? And does the information on all these 4 reports match up in terms of the price and the product itself? If everything matches up properly, then we can check everything on that invoice approval checklist, and then we have permission to move on to the final step, which is to actually issue the check. So that is our voucher system. It's a very detailed system, but it is necessary to make sure that we're paying for things that are appropriate. So if you think back to an earlier video, we were talking about purchases and we talked about discounts. And one of the things I said in that video is that sometimes we will miss a discount. So imagine that we have 10 days as a discount opportunity. Well, it's going to take us quite a while to process all this paperwork, and we have to make sure that everything is in order before we issue the check. So that's one of the main reasons why we would sometimes potentially miss a discount, because we have to go through that voucher system. Now the next control of cash is called petty cash. From time to time, we're going to have spontaneous things that happen. And even though it would be perfect and ideal to always pay with a check, it's not necessarily always going to be possible. So when we have little things that come up spontaneous, unexpected, we have to have a certain amount of petty cash. And these would be things like postage, office supplies, delivery charges, day-to-day things, small items that come up at the last minute. Now, in order to facilitate this, we're going to have an employee that will be designated the petty cashier. And anyone that requests petty cash, they're going to have to go to this person and explain why they want this money and what it's going to be used for. And after they obtain the money, they have to then return and provide a receipt and also the correct change. So that is the proper way to go about handling and facilitating petty cash. Now, on the accounting side of things, if we're going to have this petty cash fund, we have to establish the fund. And that requires a journal entry. So if you look at this journal entry, we're going to debit petty cash and credit cash. So really all we're doing is just reclassifying cash as petty cash. Now the amount involved here is $500. There's a lot of thought that goes into that amount. You want to have enough petty cash on hand to cover all the potential expenses, but at the same time, remember, one of our internal control principles is we don't want to have too much cash laying around. So we want to keep this as close as possible. We don't want to have too much, but then again, we want to have enough on hand to cover all the potential expenses. And then at the end of every month, the petty cash fund will be replenished. And we will receive a report from the petty cashier that will give us the detail about everything that the money was spent on. So for example, if you look at this, say that they spent a little bit of money on delivery charges, postage, office supplies, pretty typical day-to-day spontaneous events that happen. We could debit each and every one of these and credit cash for the total. And that just simply replenishes that fund. So we do that at the end of every month, and you would see debits to any and all expenses that might have been utilized. And then another option is we could decide, if we feel that we need to, increase the petty cash fund. That's always an option. And say, for example, that $500 fund that we talked about earlier, maybe we feel that that's not enough. Maybe we feel that we should increase that to $600. So if I do that, I don't do the journal entry for $600, I just do an extra $100. I just add in that extra $100 to raise that fund to a slightly higher amount. And if I wanted to, I could also decrease the fund by reversing that journal entry. So we always want to keep that as close as possible to the actual amount of petty cash that will be needed. Now, the final control of cash that we're going to talk about has to do with our bank account. Now, every month we're going to have to perform what is called a bank reconciliation. The reason that we have to do this is because we actually have two different versions of cash. Now, we have our own internal records that we keep, and we have an idea based on those records about what our cash balance is. But we also have a bank account, and for that bank account, we will receive a bank statement in the mail. Now, when we look at that bank statement, the balance of cash is not necessarily going to match the balance of cash that we have recorded. They're always going to be slightly different. So we have to account for that difference. And the way we do that is by performing the bank reconciliation. Because to reconcile means to bring two things together and get them to agree. So we want these two balances that are different to be brought together and into agreement. Now, in order to do this, we're going to have to look at 5 issues, 5 potential problems that might cause our two balances to be different. The first issue is called deposits in transit. And what happens in this situation is sometimes we will go to the bank and make a deposit, and maybe that deposit is at the end of the day, it could be late at night, it could be on a weekend, it could be at the end of the month. And as a result, it's going to take a while before that is processed and before it will show up on the bank statement. So that is a potential problem. And the way that we would reconcile that problem is very simple. We would add that amount to the bank balance. That would reconcile the deposits in transit. Another issue are the outstanding checks. There's always going to be a delay between the time that we write the check and when the check finally clears the bank. So that's always going to cause a slight discrepancy. But again, we can account for that. And the way we can reconcile that is we can deduct those outstanding checks from the bank balance. That will actually reconcile the outstanding checks. Another potential problem are deductions. From time to time, the bank will actually deduct money from our account. And there's lots of reasons why they would do that. It could be a charge, it could be a service fee, it could be a bad check that went through our account. But that happens many times, and usually we don't even realize that has happened until we look at our bank statement. So that's one of the values of looking at that statement and going through the bank reconciliation process. But any deductions that have been made can be easily reconciled. We will deduct that from the accounting balance. The fourth area of concern would be collections. From time to time, the bank will actually deposit money in our account. Sometimes the bank will collect something on our behalf, or maybe they will give us a credit for interest that we've earned. But in any case, if they deposit money into our account, that can easily be reconciled. We will simply add that to the accounting balance. And then the fifth area of concern would be errors. And errors are occasionally made. And it's possible that we might have made an error in our accounting records, and it's also possible that the bank occasionally might make an error. And again, this is one of the main reasons why it's so valuable to complete the bank reconciliation, because it provides you an opportunity to discover and then correct these errors. But in terms of reconciliation, errors are the toughest to fix because we don't necessarily know who made the error and whether or not it is positive or negative. So in these situations, we have to look at it on a case-by-case basis, and it's possible that we might have to maybe add this or maybe deduct. So we will see when we do our bank reconciliation, and we will do one in our demo problem, if we do have an error, we might have to make some adjustments for that. Now, once we complete the bank reconciliation, then we have a series of journal entries. And these journal entries are designed to correct our cash balance. And for every adjustment that has to be made on the accounting records, we will go in and make that adjustment with the entry. And the idea is that once these entries are posted, it will make all the corrections that are necessary in order to reconcile our bank account. And it's very important that we get those two accounts, the two balances, to match and be reconciled.